All right, let's jump right in. Welcome to the War Room. For this explainer, I really want you to put on your risk manager hat. Because today, we're building a complete masterclass framework to protect client capital from those black swan structural market failures. We're looking at the COMEX gold market, but definitely not the way the crowd looks at it. We're going deep into the delivery mechanism, that exact critical point where paper promises crash right into physical reality.
Now, pretty much everyone in the COMEX gold futures market operates under this quiet assumption, right? They think futures are just paper and they're never ever going to have to actually deliver or take delivery of real physical gold. And honestly, that assumption holds up about 98% of the time. 98% of contracts just settle in cash. But it's that remaining 2%, the tiny fraction actually going to physical delivery, that dictates the entire market structural integrity. If you're only looking at the 98%, you're flying completely blind to the real risks.
So, it all boils down to one crucial reality. The physical settles the paper. When that massive paper market completely diverges from physical reality, maybe there's a logistics breakdown or some huge unexpected surge in demand, this tiny 2% delivery mechanism acts as a violent tether. It's the ultimate enforcer, pulling paper prices kicking and screaming back into alignment with the actual physical metal. And when that tether seizes up, you literally get absolute chaos.
Here's our roadmap for this explainer. We'll start with the paper market illusion, break down the anatomy of a squeeze, and then identify the specific red flags. After that, we'll track the delivery data, run through a hypothetical squeeze scenario, and finish up with our risk manager's checklist.
All right, Section 1, the paper market illusion, the quiet assumption of COMEX futures. It's wild when you see the stark contrast between these two worlds. The commitments of traders, or the COT report, shows us the massive size of the armies on the paper side. Over there, a paper short just buys back a contract to exit a trade, completely extinguishing it with cash. Super simple, right? But on the physical side, that's where the market actually has teeth. A physical short is legally on the hook to produce a highly specific, exchange-approved 100-ounce or 1 kilogram bar of gold, and it has to be sitting in a licensed COMEX vault. The crazy part is the COT report completely fails to tell us who actually holds those physical weapons.
Moving on to Section 2, anatomy of a squeeze. And what happens when shorts absolutely cannot deliver?
To really grasp this, we have to rethink what a market crisis actually is. A delivery squeeze isn't some global shortage of gold. It's a highly localized structural failure where trapped shorts simply cannot source COMEX deliverable metal. Just look at the three main types of shorts here. You've got hedgers, like your mining producers. They actually have the metal coming out of the ground, so their vulnerability is super low. But then look at the speculative shorts, the managed money. They possess absolutely zero physical metal, nothing. So if they get handed a delivery notice, their vulnerability is extreme. They are forced to buy back those contracts at literally any price the market demands.
And that brings us to the intermediaries, the swap dealers. Imagine a hypothetical breakdown where a massive 70% of the short interest is concentrated entirely in swap dealers. That tells us the market is incredibly vulnerable. Why? Well, these are massive banks that intermediate trades. Sure, they might have access to gold over in London or in the over-the-counter markets, but they might not hold it in the exact vault or the exact form required by the COMEX. So if a huge wave of longs suddenly demands physical delivery, those swap dealers are going to be scrambling.
Which leads us to Section 3, identifying the red flags, specifically the quantitative warning signs for a structural failure.
As risk managers, we can't just operate on theories. We need hard numbers. Our primary red flag is the coverage ratio. This metric definitively measures the glaring mismatch between the total paper promises floating around and the actual deliverable inventory sitting in the vaults. The math is straightforward. You take the total open interest in the expiring month, multiply it by 100 ounces per contract, and then divide that by the registered inventory, which is the gold that's actually cleared and available for delivery.
And a coverage ratio greater than 10 to 1? That puts us squarely in the danger zone. It's a massive, blinking red light signaling an imminent structural failure. It literally means there are 10 times as many paper claims as there is available physical gold. In an environment like that, even a minor, completely unexpected bump in demand for physical delivery will drain the available inventory in a flash and spark a massive short covering panic.
Let's dive into Section 4, tracking the delivery data, and how we actually build the daily tracker. We are going to learn exactly how to integrate warehouse data with those COT reports using the CME's daily issuance and stopping report.
By following these 4 actionable steps, you basically turn static weekly data into a dynamic real-time radar. First, you note the total open interest right before first notice day. Second, every single day, you track the cumulative stopped notices. And stopping a notice just means a long has officially accepted the delivery. Third, convert those notices directly into contracts. And fourth, calculate your delivery rate by dividing the stopped contracts by your initial open interest. Normally, you'll see a delivery rate of maybe 1 to 5%, but if you start seeing 10 or 20%, you are witnessing a massive physical run on the exchange.
Now, you have to interpret this data correctly. High issuance from shorts combined with a rising stopping rate from longs is a huge tell. It signals that well-capitalized entities, we're talking sovereign wealth funds or ETF-authorized participants, are aggressively accumulating physical metal. They aren't just messing around with paper, they're backing up the truck for real demand. On the flip side, high issuance with low stopping, that means the delivery notices are just bouncing around like a hot potato. It tells you the longs are likely distressed speculators who don't actually have the cash to take down the physical metal. All right, Section 5, the hypothetical squeeze scenario. We are putting the framework to the test. Let's walk through how this looks in practice when dangerously low registered inventory triggers a squeeze against a massive swap dealer short position. Weeks before the delivery period, in the accumulation phase, a major player builds a huge long position while warehouse inventory drops. Then we hit first notice day, the stand. The long holds their ground and demands the actual metal. And man, the tension just explodes during phase 3, the scramble. This is when trapped speculative and intermediary shorts realize they literally cannot source COMEX-approved physical gold. They are forced to buy that contracts at absolutely any price to avoid a default. That drives the market into pure chaos and blows out the spread between paper and physical prices. Finally, in the resolution, either metal has to be flown in at massive expense or regulators have to step in.
Which brings us to our final section, Section 6, the Risk Manager's Checklist, your ultimate defense shield. To prevent institutional overexposure during these crazy periods of delivery uncertainty, you absolutely must build this into a disciplined weekly risk assessment template. Every week, you identify the active month, you calculate exactly what percentage of shorts possess zero metal, you verify if that coverage ratio is creeping into the danger zone above 10, you track if big players are persistently accumulating longs instead of just rolling them over, and once that delivery period kicks off, you monitor the daily stopping rate against the remaining registered inventory. Executing this strict checklist forces us to objectively evaluate if inventory is rapidly depleting and if speculative shorts are about to be squeezed out of existence. This is how you protect client capital. So I want to leave you with this final provocative thought. The risk models you're relying on today, what are they actually measuring? If your models are only analyzing the 98% of the market that operates on paper promises, are you really prepared for the 2% of physical reality that could entirely destroy your portfolio? Remember, the physical always settles the paper. Make sure your models know the difference.